So this is the relative valuation workshop. I've made a little agenda like the CFA style using their language. So the objective of this workshop is to explain why relative valuation is widely used, to identify the types of relative valuations, and to justify the reasoning behind the multiples that you use in your presentation, which the third objective would be the most important of today's workshop. So before we do go into those, let's take a minute to talk about what relative valuation really is. So it is calculating a stock price of the target firm using price multiples or enterprise value multiples of their peers. The peers being either a company that it has it's in competition with, or a company that is comparable in the percentage of business mix, or has in a similar industry with a similar target PE or ratios, multiples that you are trying to use. So these, the relative valuation itself is based on this one law called law of one price, which shouldn't, in my opinion, be a law, but it is. You can find it in most finance textbooks under this chapter, but it's basically saying that two separate assets that have the exact same characteristics must be priced exactly the same, which, you know, is very intuitive and makes sense. Even though two companies are under different names, if they are basically doing the exact same thing, have exact same amount of cash flow, property, plants, and equipments, and literally mirrors one-to-one on what they're doing, they should be traded the same. There's nothing you should be surprised about that. It also converges later with the no arbitrage pricing, which you guys may have heard if you guys took derivative classes or fixed income classes, but the no arbitrage pricing means you price a target security, whether it be derivative or whether it be fixed income, assuming that there will be no arbitrage. Some of the advantages and disadvantages of relative valuation. So I'll talk about the advantages first. So the most prominent one would be it's quick and easy. Doesn't take more than 30 minutes usually to perform this, and it's really easy. You literally just get the peers multiples and then pretend it's the target's multiples, apply the number of your target firm, and derive the price. And it's quick and easy because there's no accounting necessary to perform the relative valuation, which is a huge advantage when it comes to performing valuation on a foreign equity, because you don't have to change the statements from GAAP to IFRS, and adjustments are pre-made and are already reflected in the multiples that you use. So it's perfect for seeking out the mispriced assets that you're looking for to add in your portfolio. And it is very effective when done in a very large volume. Whereas if you do a DCF, you'll have to manually write in the and forecast each line items, and then we'll have to derive a price, which can be very time consuming. However, disadvantages, there's pretty huge disadvantages as well. The first being it cannot be customized, and the second being it is hard to find a perfect comparable firms. So you can't really model a trend that is unique to the target firm when it comes to relative valuation. Most firms have a very unique positioning in their relative sectors, and it's nearly impossible to find a perfect competition that does exactly what the target firm is doing. And if there happens to be a firm that does exactly the same thing as your target firm, then there's a bigger problem, because it means that your target firm has literally no competitive edge over the other target firm or the other firm that exactly does what you guys are doing. So the first kind of multiples is the price multiples. Price multiples by name uses the stock price of the target firm as a numerator of the multiples. So it will be price to earnings, price to book, price to sales, or price to cash flow multiples. Let's take a price to earnings multiple first. It's the most widely recognized and used multiple, and because earning power is usually the chief driver of an investment value. Without earnings, companies will not be able to make money, which then why are you investing in a company that um, does not earn money? It's a very intuitive thought. However, the drawback, because earnings is the chief driver of the investment value, companies know that investors only or mostly look at earnings when they make the investment decisions. So if they have a high earning, they will draw more investors in. The investors will usually not have enough time to derive how these earnings are earned. So they will try to manipulate or manage their earnings to be higher, and therefore EPS is a very highly managed number. This is especially true in the financial sector when most of their earnings can be deferred later into the future. So when they have a good year, they can defer some of their earnings, and then apply it to years that later happens to be a bad year for them. They can apply those deferred earnings to that year, and this is called earnings smoothing. It makes them so that their earnings are pretty smooth all across the years when it's really not. Such accounting workarounds can lead to a managing of earnings. Now, also EPS can be zero, negative, or very small compared to price, which will make the PE basically meaningless and unusable. There has been times where earnings are zero or negative. For example, Tesla. We're all familiar with Tesla, the electric vehicle maker. They have not been able to generate any profit for first 6-7 years that they have been in business, and in that case, their earnings are negative, and therefore a PE wouldn't work because there will be a negative PE number. So the alternate to the price earnings multiples when the earnings are negative, we have quite a few here. The first that you could use is the price to book multiple. Now, price to book multiples is useful for firms not expected to be going concern. So going concern basically means a company is financially stable to meet its obligations for the foreseeable future, meaning price to book ratio is useful to value firms that are not financially stable. And most notably, a negative earnings, since price to earnings ratio would not work for a company that has a negative earnings, the reason why you're using price to book ratio is to value a company that has a negative earnings. And that exactly is what not a going concern is. A company that's not a going concern means that the company isn't generating much income so that it can support its business. However, the drawbacks of the price to book multiple would be the book value does not capture a critical non-balance sheet factor such as a human capital or reputations. So one example is how a book value doesn't really capture a non-balance sheet factor such as if a company is well known for its CEO, such as let's say Berkshire Hathaway, we all know that the famous Warren Buffett basically makes all the business decisions behind Berkshire Hathaway, and the value of Berkshire Hathaway in the stock price may reflect the value that Warren Buffett adds, but not necessarily the same can be said about their balance sheet. Their balance sheet cannot reflect the value that Warren Buffett adds to the company, and therefore book value multiple will not do so. It's also difficult to compare companies with asset-related business models. Again, because of the reason said, um, book value does not really capture a some of the assets that are critical to some companies. Now, accounting effects also can compromise the usefulness of book value, um, such as intangibles, brands, patents, which are not included as assets, as well as non-financial assets and liabilities, can eventually affect the book value, which can, so to speak, corrupt the price to book multiple. Next up is the price to sales multiple. The reason why we use sales would be because sales is much less subject to manipulation. You can't really make up sales, and even if you do, it will be very easy to spot out later on. Um, Also, sales cannot be negative, so you will not ever get a negative price to sales multiple, so you can just apply it to anywhere you'd like. And sales tend to be more stable than EPS. It's also appropriate for mature, cyclical, and zero income firms. It would be appropriate for mature firms because price is much more stable than their earnings at the mature stage of the business cycle. It will be also appropriate for cyclical companies because they will have an EPS that is very volatile depending on the cyclicality of its business. So if you use a price to sales multiple, you can capture those cyclicalities better than if you use the EPS with price to earnings. And zero income firms because, you know, when earnings is zero, you can't really have a price to earnings multiple. However, the drawbacks of price sales is that high sales does not necessarily equal high profit or high earnings or high cash, which the company will eventually need to increase its value. Price to sales is also a logical mismatching. But what I mean by this statement is the share price reflects the effect of debt, while sales don't necessarily reflect the value of the debt on the capital structure of a company. So price to sales doesn't necessarily capture the effect of debt. And if the price reflects the effect of debt, but the sales do not, then you're comparing something that has a debt impact and something that does not have a debt impact, which then is a logical mismatch. And you're comparing apples to oranges at that point. Also, some companies have a weird or not normal revenue recognition, and that can also distort price to sales. But that is also a very small percentage of firms that will have an issue with revenue recognition. The last price multiple that I'm going to introduce to you guys is price to cash flow multiple. The reason why we would use cash flow is because it's also less subject to manipulation. You can't really, you'd have to try really hard to manipulate cash flow because a lot of calculations go into the cash flow to operation or free cash flow. It also sidesteps issues related to accounting choices because cash flow, free cash flow to equity basically takes out the financing decision of a company. Free cash flow to the equity will sidestep the issues related to accounting choices. However, the drawback is that free cash flow to the equity, as I just said, is most appropriate to use for as price to cash flow, but is also very volatile. Cash flow is also still open to some degree of manipulation, and CFO under GAAP may differ from CFO under IFRS and is not really readily comparable. Next, we have the enterprise value multiples. The one that's very widely used is EV to EBITDA multiple. And the reason why people use it is EV, enterprise value, is more appropriate for comparing companies with different financial leverage. So if you have a company that is operated mostly in equity in a company that is 50-50 in their capital structure, it is hard to gauge the impact of debt with the price multiples, but it's relatively easier to do that with the enterprise value because you will have to take out the debt at the end. Because you're left with an enterprise value, you will have to calculate the price from the enterprise value that you get to the price. So and also EBITDA controls for differences in capital intensiveness. So capital intensiveness refers to business processes that require large amount of investment to produce goods or services, and thus have a high percentage of property, plants, and equipment or fixed assets. EBITDA basically flattens out the differences in the capital intensiveness. So no matter you're comparing a business that requires a high PP&E or a low PP&E, EBITDA can adjust for the differences and make it readily available for you to compare those companies. However, the drawback is that EBITDA will overestimate cash flow to the operations if the changes in net operating working capital is above zero and the difference between capital expenditure and depreciation is zero. This is a basic rule of accounting, and I will not dig deeper into this in this workshop. I just want you guys to know that if the net working capital changes in net working capital and the difference between capex and depreciation are both positive, then EBITDA may overestimate cash flow to the operation, and this overestimating cash flow to the operation will mean overestimating in the free cash flow. There are other multiples, EV multiples that you can use: EV to free cash flow to the firm, EV to EBITDA, including rent, EV to EBITDA if there's little depreciation and most of the non-cash charges are amortization, and EBIT if both depreciation and amortization is insignificant. There's also enterprise value over sales, which can be considered if the target firm's EBITDA is negative. And also EV to sales is better measured than price to sales because, as I said, price to sales does not really include the effect of debt. Well, again, not all portion of sales belong to the investors as well, but all portion of sales do belong to the enterprise, to the company. So using EV to sales is much more appropriate than using using price to sales. So in conclusion, we have a few variables to consider when we use multiples relative valuations. Earnings surprises, whether there's going to be unexpected earnings in the coming years, or if you have encountered a earnings surprise that happened in one year and does not happen on the other years, you will have to take them out of your calculation because those are outliers. Also, you'll have to watch for recurring versus one-time earnings. If a company operates in a lot in one-time earnings, then the company's true earnings would be relatively low because their source of earnings is one time, and that's not very sustainable. Manipulated earnings, I have put a star on it because you and I, none of us will be able to really see it until an investigation has been done if it's flagged as manipulated earnings. But if those do happen, then we'll have to take it out. If a company has history of manipulating earnings, then we will have to take that into account and see whether there's any suspicious earnings surprises later on. We'll also have to consider the positivity of earnings and or EBITDA to perform price to earnings or enterprise value to EBITDA multiples. You'll have to consider the target firm's financial stability, going concern to be using price to book ratio, and also the non-balance sheet factors. Also, revenue recognition is also a variable to consider when you are trying to use price to sales ratio or enterprise value to sales ratio. And that wraps up the workshop. And I will now invite any questions.
I have one question.
Yes.
So when we pick comparable companies, do they have to be in the same accounting standard?
Yes. Well, yes. It would be important for them to be in the same accounting standards if you're going to use a very certain or price to cash flow, because cash flow from operations will be different under GAAP and IFRS.
Mm. And speaking of cash flow, I think Eugen, I learned from Eugen that he has a model that can detect if the company tried to manipulate the cash flow. Yeah, so it's pretty interesting.
That is very interesting. It's usually very hard for us to recognize it. I believe there is a model actually. The CFA introduces a model that scores basically. You can literally see the line items and then multiply it by a certain number and see if that number goes up to a certain threshold, and if it goes above, there may be a manipulation of earnings. But again, when I ask around people who actually work in investment industry, they say that it's not very reliable. It's just a model.
And if a company tried to manipulate, maybe there's another professional investor know about this already. We don't have to.
My rationale behind it is that how are we going to know if the auditors couldn't know before it actually got published? Because when you make your 10K, you'll have to go through an auditor first to make sure that the numbers are indeed correct. So on our end, how would we know if the auditors didn't know? Any other questions?
So just add something. Nice job, Chris. I think you did a very good job explaining how to do the valuation, especially those approach that you taught it's something included in the CFA curriculum.
Yes.
So well done. Yeah.
Most of it actually is from level 2 that I was just studying.
Nice. Hopefully, you will get past very quickly soon. And quick, the link that I sent, this is from the ARC Fund. They are mostly doing the investment in disruptive technology. So I think one thing we probably need to learn eventually is how to evaluate those high-tech companies and how to understand, the impact of those interactive technology. So that's why I'm sharing this investment process with you, so we can think as a group. I'm learning as well. How do we, evaluate those high-tech companies? They do have something like, they talk about the bottom up, top down approach, but they focus on the qualitative side. If you look at the page 4, they have the scoring process. So those are something they focus on. So maybe, we should start thinking about, if you are doing something related to technology, maybe we can focus on what's the role of those key personnel, what's the role of those top executive, and how about the product, where do they get those market share, and what's the risk of losing those market share, something like that. So I think this will give us, there are lots of YouTube video on how they manage the fund. So I think it's a great way to learn. Yeah, that's just something